Welcome to Industry Focus. I'm Nick Sciple. It's Thursday, and we are talking energy. My guest today is Jason Hall. Big news this morning. We talked about last week. President Trump tweeted about some rumors that the Saudis and Russia could be cutting oil production. Well, today we got some official news on that after an OPEC Plus meeting this morning, which I think still may be ongoing, with reports suggesting that there is an agreement to cut 10 million barrels per day of oil. Jason, just high level, what are your thoughts on this news so far?
Depends on where you start, where you're counting how much oil is actually being cut, right? So it's a good sign, and I think it was kind of inevitable we were going to see some cuts. Tomorrow, I think we've got the G20 energy ministers are talking, so this is going to be ongoing for a little bit. But I think the big thing that investors need to take away from this is the market's still going to be just massively oversupplied, and it's going to be months and months of oversupply. I mean, these 10 million barrel cut, I don't know, I think we figure that's less than half of what the demand destruction alone should be. I mean, Delta Airlines said their revenue is going to be down 90%. Jets use a lot of fuel. Nobody in America is commuting to work anymore. I just read that something like a third of American renters have not paid their rent in April. This doesn't change the thesis, right? It's going to get ugly.
Right. So this cut of 10 million barrels per day, to your point on, depends where you measure from. At least for the Saudis, they're cutting 4 million barrels per day, or at least have agreed to. And this is off their record production levels in April. So it's worth noting that when this price war first started, the Saudis announced that they were going to bump oil production up to around 13 million barrels per day. If you net out so those increases of production from where they agreed to cut, we're looking at around 1.5 million barrels per day cut from where we started the year. The Russians have announced they're going to cut 2 million barrels per day. This is against a backdrop of, as you mentioned, if you look at the projections of the demand destruction we're going to look at, it's anywhere from 20 million barrels per day to as high as 35. So we're looking at tens of millions of barrels each day that need to go into storage or need to go somewhere, and the market's going to have to adjust for that. One of the questions that I have around this cut is to what extent are we going to see compliance? I think in the past, Russia in particular has been notorious for saying they're going to cut and then not necessarily complying. When you look at that, any thoughts there on how much of this is narrative and how much of this is going to be actual action by these countries?
So I think we're probably going to see a little more action in this environment than we have when things are a little bit more normal. Just simply because, I mean, this is the demand destruction so bad that I think even Russia is going to run into problems with where to put the oil, right? So I think I've read some really interesting things over the past couple of weeks that talked about the tactics that Saudi Arabia has used over the past roughly month to really, because this started out, of course, with Saudi Arabia really kind of going after Russia's production and the logistics of the way oil gets moved. Saudi Arabia really targeted flooding in markets that Russia tends to target to really kind of paint them into a corner with nowhere to put their oil. And the follow-on effect of that is here in the U.S. We've seen demand destruction create a situation where U.S. producers are by mid-May are going to be in the same boat. There's going to be nowhere to put all the oil, right? So I think we're going to see a little more of these commitments being made simply because there's nowhere to put the oil, right? So, but I mean, the bottom line is that Saudi Arabia's tack under the OPEC Plus group, which includes Russia as a key producer, has their thought process in the past has been, hey, just getting Russia to say we're going to cut is a stabilizing factor, whether the cuts actually happen or not. But yeah, I think if you look at where Saudi Arabia is going to be, I think they've agreed to like 8.3 million barrels a day in production, and that's about 1.5 million down from where they were under the regime that expired at the end of March. So the big 4 million they're talking about, as you alluded to, that's from their production today, right? Where we think that they probably are today. So that's kind of where that is. But again, I want to put some context on the demand destruction that we're seeing and what 10 million really means. So, a month ago or a couple weeks ago, we were hearing from some of the big oil traders there that kind of, give a lot of information that the market kind of uses to price in oil. Some of the expectations were that 20 million barrel a day decline, and now the numbers are getting bigger. But 20 million barrels a day, that's essentially what Russia and Saudi Arabia combined to produce on an average day last year. So, I mean, we're talking about the number 2 and number 3 oil producers in the world behind the U.S. All of their production is falling off the market in demand, and like you said, there's even that up to 35 million. So here's the thing, right? So you take 10 million off the market. And again, that's 10 million from today. So it's really more like 6 or 7 million if you start paring things back and looking at prior production levels. I mean, that's a bare fraction of the demand destruction that we're going to see. So think about the carry-on effects of that. So again, think about the U.S. We're more or less on track to be out of storage in the U.S. by mid-May. So what that means is that producers right now that are already cash starved because oil prices have fallen, essentially 60%, in some cases far more than 60%. They're going to get another hit when some of these producers are going to be forced to shut in their production. In other words, they can't just cut CapEx and let the decline curve of the wells be the guide to push their production down. They're going to actually have to go turn off the taps, physically turn off the taps, cut off their cash flows even more, because there's literally nowhere in the pipe for that oil to go. So the bottom line is that this, again, I don't think it really changes the thesis or the trajectory. It's going to lessen the pain for the big oil majors. It's going to lessen the pain down the road. But let's get through April. Let's get through May. Let's get into June, the summer. Ideally, maybe the economy can start to open up. People can start driving to work again. Some people, again, not everybody, some people. Airline travel might start to open up a little bit, not much, because you got a lot of people that spend money to go on vacations that aren't going to have money to spend to go on vacations, that are going to be concerned about international travel and being, in a tube 5 miles in the air with 200 other people that could be sick. I mean, there's going to be a lot of cultural, things, and just it's not like somebody's going to flip the switch on June 1st and oil demand's going to shoot up another 20 million barrels, and all the guys in West Texas are going to crank up their rigs and just start pumping oil again. There's going to still be, tens of millions of, maybe hundreds of millions of barrels of oil around the world in tanker ships and in storage facilities that's still going to have to be consumed before production can start to recover, right? And there's a lot of independent producers. There's a lot of, independent, the service companies, the guys that drill the wells, the guys that deliver the frac sand and do all those other things, that are going to run out of money, right? If you're a banker in West Texas, you're not answering the phone when the executive from the already leveraged independent oil producer calls you. So things, I think things are going to get worse before they get better for the industry. And this the cut's good. It's a good sign, but it doesn't. I mean, for me, it doesn't really change the thesis, right?
Yeah, I agree with you completely. You look at some of these names. I've just charted a few of them. Continental Resources up 50%, 56% in the past 5 days. Occidental Petroleum up almost 30%. Antero Resources over a double in the past 5 days. The thesis for these companies have not changed. These companies were challenged before anyone had ever heard of coronavirus. These companies were challenged, heavily indebted, not producing cash flow. This is not thesis changing for these companies. This isn't a time to go look at the E&P companies. They're gonna rally back now. This is an area to avoid. I've said this in the past. I think the only clear beneficiaries from what's going on right now in the oil market, as you mentioned, Jason, are these tanker companies, and even then, they're notoriously volatile and tough to invest in. This is just a really, really tough area to be involved in right now. And there is still some resistance from some of these producers to cut production. They're saying, hey, we don't want to, we want to let kind of decline curves roll off, that sort of thing. I think Occidental Petroleum specifically has called out, we don't want the government to limit the amount we can produce. So we'll just have to see with these guys. This is not a time to jump in to oil stocks by any stretch of the imagination. I just want to reiterate that as much as possible. Now, when it comes to jumping in oil stocks, though, there was news as well yesterday, also from the Saudis, that their public investment fund had invested $1 billion in a basket of European oil majors, including Total, Equinor, Shell, and Eni. And so, Jason, when you see this, obviously the Saudis do have some inside information here on what cuts were going to come down the line. Throwing $1 billion into these major oil companies, what is your reaction to that?
So a couple things. The Saudi sovereign wealth fund, I think it has what, $300 billion or so in investments.
Yep.
So that's 1/3%. It's not like they've gone big here. Yeah, $1 billion is big, but as a percentage of those assets, it's not a ton of money. And one of the things too is that over the past few years, there's the idea that the sovereign wealth fund was going to focus more on technology and help kind of be a driver to start creating the future of what the Saudi economy is going to look like. And it's still doing that to a large extent, but here's the bottom line: if you look in the oil patch, if you're an investor, right now is a great time to focus on what you understand and what you know, right? Because if you know a certain business or a certain market or a certain industry well, now's the time you can find the best bargains, right? The best opportunities to grow your returns when the market is down. And I think what they're doing is they're saying, look, Shell's down by half. It's a great business. They have a massive amount of cash. They have a strong natural gas business that's still going to be pretty viable even as this plays out. The petrochemicals business is pretty good. And we probably know what their production costs are better than a lot of people that work for Shell know. So they're saying, we can buy an asset at half price, and in a few years we're going to realize some value there. So I think that's part of it. I think the other part of it is you notably you don't see ExxonMobil, you don't see Chevron, you don't see any American super majors as part of these investments. The relationship. The U.S. buys a ton of oil from the Middle East, not as much as we used to. But Europe buys a lot more. So I think that's more of a kind of a political signaling of where their interests are than anything else. But I don't think it really represents some major strategic shift for how Saudi's going to invest its money. I think it's just a smart tactical move to take advantage of the beaten down assets that are the ones that are going to generate positive returns with the least amount of risk from the sector. So I think that's an important thing to remember as an investor. If you're just dead set on owning something in the oil patch and taking advantage of the downturn, and actually I wrote about this. Had an article called "Are Oil Stocks Cheaper? Value Traps" that we just ran yesterday, and I suggest you take a look at it. But it highlights the fact that right now in this segment of the business, the best move to make is to find the companies that can avoid failing, right? You want to protect the downside first. So the strong, well-capitalized, the businesses that have the best access to capital, that have some diversity in their operations. So you avoid those unforced errors by investing in companies that that just frankly they may fail because they run out of money. Then you can capture return. So I think that's essentially what they're doing.
Yeah, one other thing I'll mention, we mentioned the importance of the narrative earlier, so saying the Russians will cut even if they might not necessarily comply. You can see how this $1 billion investment is incredibly powerful for the narrative that oil prices are going to be supported and that sort of thing. Just that report that the Saudis are buying these oil stocks, I think gave a lot of people this signal that, hey, maybe I can go in and buy. So whether I think those companies across the board share those characteristics you mentioned of they have balance sheets to survive, that sort of thing. But as well, I think this move is very powerful for the narrative that the Saudis are trying to put out as well. One other big investment, and we may not have deep thoughts here, but it is quite interesting, as the Saudis bought an 8.2% of the common stock outstanding in Carnival Corp, the cruise line. Obviously, the cruise lines have been suffering majorly as a result of this coronavirus. A lot of these, virus-laden ships floating around the oceans across the world, and that's driven down a lot of the stock prices. The Saudis jumping into Carnival. Well, what do you think about that move, Jason?
I have very little of value to say here. First of all, cruise lines, airlines, hotels, these are all industries that are just getting pummeled right now, right? And it's gonna take some time. I think you're gonna see, a lot of hotels are probably gonna bounce back faster than the others because it's a little, it's cheaper. It's a more important business spend where businesses are going to start spending for travel a little bit more. But just I think the cruise lines are really just going to have a tough time bouncing back. But so you think about so what do they invest, like 600-800 million, somewhere around there. Again, it's a bare fraction of that Saudi wealth fund, and Carnival is one of the bigger, more well-known brands in that space. So, you know, maybe call it a flyer.
Right.
So, but I'm not. It's. I think there's still too much risk that yeah, it's not a space I'm looking to go after.
Yeah, it's not a space I would pile in, and if I wouldn't necessarily use the Saudi Public Investment Fund as my signal of places to buy into. If you look at their track record, it hasn't necessarily been the best in the world, but quite interesting that somebody is believing in a significant way in Carnival. The other big move, and this is away from the energy space, but Warren Buffett, news came out last week that he had sold down his stakes in Delta and Southwest. Now, this is interesting. Anytime the Buffett buys or sells a stock, it's interesting, but it's particularly interesting because this came, I believe, less than a month or just over a month after Warren Buffett had increased his stakes in Delta. So when you see Warren Buffett selling the airlines here, reaction to that?
I think the biggest lesson investors can take away from this is even the best investors in the world are subject to unforeseen events and can get it wrong sometimes, right? This is, sure, a month or so ago, 6 weeks ago, you could say, well, this coronavirus thing is going to be pretty bad. But I think the full implications were really hard to really understand in terms of what it would mean for the airline industry. So the point is that it's if it's going to happen to Buffett, it's going to happen to you, and that's okay. So don't get too caught up in being precise with your investments and thinking you have to get everything right. Now, in terms of the selling, it's a couple things. Again, I'm just spitballing this a little bit. I think part of it could be, there's different rules for different industries for owning more than 10% of a company, right? In terms of what you have to disclose, but also I know, like with the banking industry, you have to make these disclosures about being a passive investor, and it really limits your ability to have an influence. And so that's one of the reasons that Berkshire's routinely sold shares of Wells Fargo over the past few years, is to stay below that 10% threshold, because Wells Fargo has been aggressively repurchasing shares. So Berkshire's had to sell to kind of stay below that threshold. So I can't help but wonder if and again, it may not be Buffett, right? It could be Ted or Todd, who manage, between the two of them, probably $40 or $50 billion of Berkshire investor capital now. Just maybe they're thinking, we really need to stay below that 10% threshold. Especially if there's going to be government bailout money or anything like that. I mean, there just could be other implications, and they may just think it may just be a safer place right now to stay below those thresholds right now. So just making a guess.
Yeah, it's worth noting that 10% threshold is the only reason we know about this transaction at all. Because if you're a 10% or greater holder, your regulations require you to disclose sales. And for all other transactions, we're not going to know what Berkshire Hathaway has done until 45 days after the end of the quarter, when their 13F filing comes out. So that should be around May 15th, I believe, and when we'll know all the rest of the transactions that they've taken place. I will say one thing about Buffett selling, and I think it's a valuable. You mentioned some valuable lessons for that when it comes to not always being right, and also it's admitting when you're wrong. And I think Buffett has done a good job of that in the past. You look at his IBM investment, you look at a number of other investments he's made in the past. He's not afraid to admit when he is wrong and cut his losses and move on and redeploy that capital to more attractive opportunities. And I think that's something that we can learn from as individual investors as well. Want to move on to a couple listener questions. we got a number of questions about the Brookfield Infrastructure Corporation conversion that came, or spin out that came in the past recent weeks. So I read a question from Ed. Ed says, I've been a Motley Fool subscriber since 2005 and have been a listener of all of your podcasts since day one. Thanks for the great podcast. Well, thank you, Ed. He said he's owned Brookfield Infrastructure Partners for a while now, originally bought a small portion during the financial crisis and have added more in recent years. His question is on the unit split that just happened in March. Are investors supposed to receive one share of Brookfield Infrastructure Corporation for every 9 years of, for every 9 shares of Brookfield Infrastructure Partners they own? Jason, just high level, what are the details of this spinoff? Why is it happening?
Yeah, so that's exactly how it reads. Brookfield explains it. For every 9 units of BIP, Brookfield Infrastructure Partners, an investor owns, they'll receive 1 share of BIPC, which is Brookfield Infrastructure Corporation. And any fractional shares, you get that paid out in cash. So the short version is that the motivation behind this spinoff is that Brookfield Infrastructure Partners is a publicly traded partnership. Often you'll read about it, and it's called an MLP. It's not exactly an MLP, but for our purposes, it's basically the same thing. There's more limits on who will and who can invest in an MLP. Some institutional investors have rules in place, often for tax reasons. A lot of indices do not include MLPs. And again, honestly, a lot of times it's for because of the tax implications. If there are ETFs or mutual funds that track those indices, some brokerages won't even let investors buy MLP units inside retirement accounts because of tax consequences. There's something called UBTI. It stands for Unrelated Business Taxable Income. There's situations where you could actually end up having to pay income tax on an investment inside of your retirement account with these partnerships. So by creating BIPC, Brookfield sidesteps all those tax implications and the other things that they limit the investor pool. So this should increase the size of the investor pool. That consider the corporate BIPC to be an appropriate investment. Now, by doing it as a spinoff and awarding existing investors an equivalent stake in shares of BIPC, it makes it a non-taxable event. So it's just a little bit cleaner way to do it that way. Each share of BIPC is economically equivalent to BIP. So dollar for dollar, I mean, they're essentially the same thing. But the difference boils down to tax consequences. If you own BIP now, you're getting the dreaded K1. It's just a complicated tax document. It's kind of a pain in the butt when tax season comes. Your tax it's not a lot of fun to deal with. Versus a 1099. That BIPC will send out. That's like the dividends that you get from, like, if you own Coca-Cola or Nucor Corporation or something like that. So it's a lot cleaner. It's easier. It also means all those problems with owning it inside of a retirement account should go away. So that's the short version right there. It's something that a lot of people have been kind of asking for a long time. Brookfield has been steadfast that its partnerships are fine to own in retirement accounts because they don't pay the UBTI. But again, some brokerages, my wife's Merrill Lynch retirement account, can't buy it in BIP inside of that. So it's going to be nice now for me as personally to be able to take advantage of it.
Right, and this is something Brookfield is doing across its portfolio, right? I mean, I know they did the Brookfield Property REIT to go with the BPR MLP. I think they're doing the same thing with Brookfield Renewable. Is that correct?
Yeah, Brookfield Renewable Partners, that's BEP. They're planning to do the same thing later this year. The Brookfield Renewable and Terraform Power, ticker TERP. Brookfield Renewable already owned almost 70% of Terraform Power. They just struck a deal to buy the rest of it. And Terraform Power is just a corporation, so there were some substantial potential implications for existing Terraform Power shareholders. if they did not do something like this. So later this summer, once the Terraform Power deal is ready to close, they're going to do the same thing with Brookfield Renewable Partners. I think it's a good move for everyone. I know we had one of our listeners, Brian, asked about trading out with Brookfield Infrastructure his MLP, his BIP share units, and buying BIPC shares. And I think that's a reasonable. I'm planning to do that in my solo 401k, simply because I don't want to have to deal with the K1. So without having trading fees, it's a little more. You don't have as much friction and cost to do it. So I know I'm planning on doing it. And since it's inside the retirement account, the capital gains I won't have to pay any taxes. So yeah, I think it's a reasonable move for people to consider just shifting over to BIPC inside of those retirement vehicles. Now, if you own it in a taxable account, I think you got to be careful about deciding just to sell the partnership to flip into the corporate shares, because if you've made money on the share price, you're still going to have to pay taxes on your capital gains. So just everybody should think about those implications before you do anything.
We can't give personal tax advice, but I think in that case, definitely talk to a tax advisor.
Absolutely.
To figure out your potential tax liability and how that could affect you. I know Brookfield Infrastructure is a personal holding of yours, Jason. When you look at it right now, this is a stock that sold off almost 50%, has rallied back now in the past month or so. When you look at the stock today, it's still attractive at this price.
I think so. It's still down, about 20% or so. It's one of the few businesses in my personal portfolio, Brookfield Infrastructure and Brookfield Renewable, that I really look at is kind of buy just about any time investments. The people at Brookfield are so good at allocating capital. These are recession-resistant businesses. They generate really steady cash flows. They're really good at getting great returns. They're disciplined about allocating and reinvesting capital. Anytime you can buy it, 20% less than the price it traded for, a month and a half ago, I think it's worth buying.
Yeah, you mentioned recession-resistant businesses. Reminds me, and I know you were working on an article about some recession-resistant companies. I know a lot of our listeners are probably looking for stocks that they can buy and kind of set and forget during these kind of uncertain times. Other than the Brookfield ones, any companies that come to mind for you that folks should be considering?
Yeah, so I think if you start dabbling a little bit outside of the you have to when you talk recession resistance, you have to get out of the oil patch. First of all, you can't. A lot of these those businesses are going to struggle. I think it's also worth looking at NextEra Energy Partners. Is a good one to look at. NextEra Energy, its parent company is a major utility. They own Florida Power and Light. NextEra Energy Partners produces a lot of wind and solar energy and owns some natural gas assets. So again, those are businesses that are pretty good. I think one to look at is Waste Management. Our colleague Tyler Crow has touted that business. It's gonna feel some impact with so many businesses shuttered right now. This is just a kind of a weird one-off event, but I think the vast majority of its revenues and cash flows should prove pretty steady and stable. And it's definitely the kind of business that you want to kind of own on both sides of a major downturn. What about you? I'm sure you got one or two you want to kick out there, Nick.
Oh gosh, yeah. So I would say put me on the spot.
That put you on the spot?
Put me on the spot. No. So I would say right now, I think I always think you mentioned the other Brookfield partnerships. I think Brookfield Asset Management be one to look at, gets exposure to all those. One that I like that's maybe a little bit more niche, kind of a financial company, is Broadridge Financial, ticker BR. This is a company that it is a technology company, but primarily in the financial space. They do electronic delivery of proxy statements and other kind of regulatory filings that companies have to send out to shareholders. They're required to by law, and they really dominate that segment of the market. They also have a product that has gotten some traction, obviously, in recent weeks for remote shareholder meetings. So this is a business that has a dominant position, providing a service that companies are required to deliver, whether or not the economy is good or not. If you're a publicly traded company, you must deliver these regulatory filings, and so they have a strong position there. I think it's a company that's going to do pretty well in this environment. 2% dividend yield, has had some decent growth over the past several years. So that's one I would be paying attention to. So I think those are the couple. I think the Brookfield companies. I think Broadridge is one, and I always like MasterCard. That's one you might say that it's. You could say that it is going to be affected by the recession in some capacity with spending going down. However, we're probably going to see more spending go digital, and I think this is a company with great management, and it's got a massive tailwind behind it. So I think any of the payments companies, but I think MasterCard's probably my favorite one of the big two between Visa and MasterCard.
It's interesting. It's interesting you say that. I agree with everything you've said. I think it's also just such a cash-efficient business that even with declines and people going to stores and swiping cards and that kind of stuff, it's still going to be a cash cow. And I think it's an interesting thing about what's happening. I think in a lot of places where cash has been king, this helps accelerate the shift to electronic and cashless payments. So I think in the long run, this could be an interesting catalyst. Here's what I'm gonna throw one more out there. We talked a lot about Warren Buffett. We talked a lot about Berkshire. Berkshire Hathaway trades for like 1.1 times book value. It's down about 15%. Its stock portfolio is down a lot more than 15%. So I think there's some pin-up value from a business that also has a massive hoard of cash that it is probably going to deploy a substantial amount of this year. I think now is I sold my Berkshire stake about 3 years ago. It's one of my top 2 or 3 that I'm looking at buying right now. And I think it's one people should really be thinking about.
Yeah, I think that's a good one. I'll give you one last one that I think is interesting, and it's pretty recession-resistant. Is Massimo, right? So Massimo is the company that makes these sensors for these oxygenation sensors when you go to the doctor's office and they clip the thing on your finger that tests your blood oxygen level. That's a company that has been taking market share in that sector for years and years and years. It's one of these. Whenever these devices, the older devices, leave their useful life, Massimo captures much of the replacement market, and people are probably going to the hospital more than ever these days. But regardless of that, it's a company that has a dominant share in this really important component. So that's one that's been on my watch list. Have not bought yet, but that is my fault. I should have owned it a long time ago.
Fair enough. I'll leave you with the last word on the picks. Nick, nice job.
Well, thanks. I do my best. All right, folks, that's all for us today. Just a reminder that the Motley Fool is closed on Friday for the Good Friday market holiday, so there will be no Friday tech show this week, but check back on Monday. Jason Moser will be back for another episode of Industry Focus Financials. Jason, as always, thank you for joining us, and have a great Easter weekend.
Same to you, my friend. Have a happy Good Friday, everybody. Talk to you soon.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Jason Hall, I'm Nick Sciple. Thanks for listening, and Fool on.